Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding, sitting next to Geoff Gannon. Jeff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great for everybody else as well. If this is the first time you are tuning in, first of all, what took you so long? Secondly, be sure to go to quickfs.net and sign up for their service, quickfs.net. I'm going to put the info in the description down below. And if you do sign up, tell them you came from Focus Compounding. If you're watching on YouTube right now, this is where we pull all of this long-term financial data. The download financials part is my favorite part. I'll do a little demo right now. You click it, it opens up through Excel, and bam, look at that. Looks beautiful, has all the data from 20 years already in Excel. So if you like to make financial models, you could pull this data yourself. But really, I just like to look at everything from a high-level overview, and that's what we use every single day and also all the time on the podcast. So go to quickfs.net and tell them that you came from Focus Compounding if you signed up. So in today's podcast, we're going to be talking about where we currently are in the market. And this is something that I think is on everybody's minds now more than ever. And again, maybe you don't experience this as much, but I feel like now more than ever, instead of hearing people talk about like great businesses at attractive valuations, moats, competitive advantages, stuff like that, it seems like the talk is all around the current debt that the United States has, inflation, the unemployment rate, stimulus, macro, the crazy high, the crazy high multiples, what is going on in the world. And we try to really tune all of it out. And I think our crowd is probably in the same boat as us, where they focus more from the bottom up as opposed to macro things. And I just thought it would be interesting to kind of get your thoughts on just everything that is going on. So to set the stage, right, we have the unemployment rate is at 4.2%. I think the pre-pandemic, the lows was like in February was like 3.5%. National debt, 29 trillion. Something that I think is interesting if you're actually looking at the screen right now. So that's
probably gross. Yeah. Okay.
I look at this website a lot, Fed blog, St. Louis Fed, just to get like a lot of information that's going on in the economy and stuff like that. And something that I thought was very interesting is that the debt is at all-time highs, but the actual cost of servicing that debt, like the interest as a percentage of it, is at lows because of where interest rates are. So
and duration, both those things.
Yes, exactly. So I think the Fed is actually in a pretty tough spot, I would say, because that's variable as well. So as interest rates rise, they're going to have to service that debt, which means that their interest payments are going to go up.
There's far less, it depends on the country, but like the United States isn't especially extreme compared to some countries, but you have much larger amount of shorter term debt out than say like 30-year debt or something.
Yeah. Well, I mean, I think that's why I know people call them crazy, but when the previous president, I think he was saying they should issue like 100-year treasury bonds or something to lock in rates before.
Yeah, if you want.
And everyone's like, that's crazy, but yeah.
Yeah, from the perspective of the country, it makes a lot of sense. Yeah. And there've been the UK had perpetual debt out, so it's been done before.
So to set the stage, So and then we had an inflation print that came by. So it was transitory. Things are going to slow down. There's bottlenecks, stuff like that. This was the result of COVID. Now the Fed is saying that it's probably a good time to retire the word transitory, right? And how much of transitory do they actually, I mean, we've talked about this before, right? They kind of say these things so it doesn't happen. Where if they, and inflation's a leading indicator in the sense of, or if you kind of project inflation, then everybody, it almost becomes a self-fulfilling thing, because then companies are going to compensate for that. They're going to raise their prices. They're going to, do all sorts of things like that. And then inflation sort of by that becomes real, manifests itself. But we had a 6.8% on the CPI, which came out last week. So a lot of people are, very, I would say, scared or shocked by that. To what's the Fed going to do? They say that they're going to slow down their tapering. People say now they may have to speed up that process of slowing down their tapering. There's the talk of rising interest rates, which is why you probably have seen a lot of these tech stocks at, per our last episode, multiples of like 100 times ARR starting to, kind of pull back and come down to earth a little bit. Buffett's talked about how interest rates act as gravity on like the financial markets. Let's tune it all out though, right? like what does the investor do today when you have the markets at all-time highs? Now, that's a little bit, I mean, what do we define as the market? The 5 biggest companies in the United States or 500 companies? Because I don't think, 500 companies are all at all-time highs. I get it. It's an index, so that's how it makes sense. But, I just feel like things are a lot worse out there right now than what you are seeing in headline numbers or with the markets just being at all-time highs. So I'm just kind of curious to hear like how you're thinking about it. We own certain companies that are sensitive to interest rates. So I'm just kind of curious to hear your thoughts on it, tuning out all the noise, just looking at the data itself, and how do we, either maneuver it or just be investors and, look for opportunity.
Yeah. So we're exposed in certain ways to some risks. The risk is really not from inflation itself, but from a big step up in interest rates if it was to be maintained for a while. That means that rates in the future are significantly higher than they were in the past if banks had made loans in the past that now are at inappropriate levels versus their funding costs. And that's very real risk. And then like shorter term, there's a spread thing. And you can see that with like 210 spread and stuff like that probably investors like it in, like say in banks, like it when that steepens and don't like it when it gets flat and it's pretty flat. Yeah. That's the shorter term rates are reacting more to the things that we're talking about than you would think longer term rates should react, which may mean that people don't really believe that once rate increases start, that they'll continue for a meaningful amount of time and stay that high. So they may believe very strongly there'll be 3 or 4 increases in the next, roughly year, maybe a little bit more than a year. But they may not believe that then rates will get to more like the level that they've seen in the past or be sustained for a long time after that. Certainly they don't believe that like this kind of number you see with inflation and stuff, normally what kind of rates that would cause is the rate you're going to see.
Meaning?
Otherwise, long-term rates would be higher.
Yeah, way higher. Yeah.
Yeah.
There's a lot of talks of the 1970s and the roaring inflation that we had and what that did to the market.
Yeah, there's some similarities. So the 1970s, although people talk about it as being the 70s and everything, it's really like 1965. You see a real change in economic numbers from that point on. Government policy, basically, a willingness to do things that would be inflationary. And here we've had 10 years of that too. Mm-hmm. So we've had that willingness to do that. And then much later you have a jump up in inflation because of something kind of random seeming or whatever. But the policy that may have enabled that was in place for a long time before then, with deficits and things like that. And so there's specific reason with COVID now. There were specific reasons with the war and things like that in the 70s. But it started earlier with a kind of willingness to abandon previous ideas about how you ran the government and how you'd run the Fed now. Same thing here. There's definitely been a change in terms of how big deficits people are comfortable with, both parties and all that, and with the Fed. I mean, they've done things for 10 years that they wouldn't have been comfortable with before then. And I'd say that's what you see in both cases. If there's other similarities, I don't know. I mean, it's always a different thing that might cause prices to increase, like consumer prices or whatever things we're looking at, asset prices. But, it is kind of similar in the sense that I'd say there's a shift in attitude, public policy attitude from the immediate period after World War II, that the attitude of the 40s and 50s shifted by the mid 60s. And I think that's true here. The attitude of 2000 of how the Fed thought it should operate and how the government thought it should operate is not the attitude of the 2010s. I think so. In that way, it's similar.
Mm-hmm. How are you thinking about it currently as you're sifting through companies and, quite frankly, thinking about the businesses that we own?
It's the most, at the time I've been investing, it has the most impact on decisions about stocks because of the risks. And the big one is the financial things with interest rate risk. If it's a lot different in the future than it was when they made decisions in the past. To some extent, inflation is an issue, but inflation is probably somewhat beneficial, on a relative basis. It's not beneficial on an absolute basis. It's bad for investors. But on a relative basis, some of the things that we own and have bought in the past and stuff would benefit compared to other stocks on a relative basis. And that's because we've always thought about inflation. And if we could get inflation protection for, free, then we would take it. In terms of the kinds of businesses that we would buy and stuff, that's always been the case. And so we have less of an issue with that. And then we always avoid things that have short-term funding needs, except for financial stuff. So, in the things that we own that are non-financials, they have not used short-term and floating debt. And obviously you wouldn't want to have that now.
Mm-hmm. So do you think it's a matter of quality, right? So the types of companies then that you're investing in, they have pricing power, they have dominant businesses. If there's inflation, they will be able to keep up with it by raising their prices. I mean, does it really come down to, from like the bottom up stock pickers perspective, just the types of companies that you're investing in?
It helps to have spent on all the assets you need in the past. So dollars at old dollars. And it helps not to have labor and suppliers and stuff with bargaining power with you. So, Amazon is a strong business, but I don't think inflation is good for Amazon. I think it's really bad for them. So it depends. You can have a really strong business and it be really bad because because of the bargaining power of others with you in the present situation. It is better to, it's better to be Maui Land and Pineapple. It's better to have 100% of your investment in something that
you bought a while
that
ago.
You're not buying any more of. Mm-hmm. And yes, look at that price. Yeah, and you see that with a lot of things. So it is interesting. I was just looking at a basket basically of all those things we've talked about, land things. So like Alico, Maui Land and Pineapple, QAnon Land Association, which is, now it's a buyout thing, but what the stock was doing before then and all of that. And they all outperformed basically for 10 years or so going into like 2006, 2007. And then since then they've underperformed the S&P. But it is interesting that people see things like that or like Party or one of those companies that actually for 10 to 15 years, they beat the S&P in the 90s. And so when stocks like these underperform for 10 or 15 years, then people think they're bad businesses and that the S&P 500 type things are a lot better businesses, but it does depend a lot on the macro sort of situation and the multiples that they're at the time. Yeah. So the thing with all of those is, for the most part, they had bought things in the past. So the land and stuff that they own, they own from things that happened a long time ago, and they're either selling off now or they're making little capital investment. That's the best things to own.
Where they don't need to put a bunch of capex back into their business.
Tollbridge is the best thing to own. So timberland is a good thing to own.
So basically, for people just to fully understand, because we just had this conversation in the car here, if, for example, they need to, let's say, build something new within the company today versus a year ago, now labor costs, whatever sort of commodities that could go into that, whether that's lumber or everything else, is way higher than where it was a year ago, just so everybody understands the concept.
Yeah, a lot of businesses, not all businesses, but plenty of businesses don't have returns on equity much above 10%. And if you're going to build something this year versus last year, it's going to be more than 10% higher. You're getting the same thing out of it, whatever that is, a building or whatever. And it costs you more. So having done it last year is better. Obviously, if you had stocked up on a lot of inventory and stuff, that's better. You see that with car dealers. If they had a lot of inventory, they have a one-time huge gain on that. But then if they turn around and now buy cars, then they have better problems. Car dealers is a good example. Used car prices are had been going up in the last year or so at the same rate at which equipment for natural gas stuff was going up at the time of the first real natural gas boom in the U.S. So we've talked about that with Penn Square and all that, about 2% a month. And that was the collateral they were lending against then. And used cars going up about 2% a month. So you have the same sort of dynamics that way. So the problem, though, is, of course, that one time you get a big gain from it, right, the inventory, but you don't have a supply of inventory in the long run. So you have to turn around and then spend that again. You saw that Friedman Industries is a steel company. Same thing. It earned some huge amount of its market cap in a single quarter. Steel prices went up. I think the kind of steel that they sell maybe 200% or something. And inventory is often very large compared to market cap. So big gain. If the company said we're liquidating, then you'd make a lot of money and stuff. But if they then turn around and try to buy as much steel in unit terms as they had before, then in essence, you're not earning anything except for that one-time bump that you had of cash. And that is what happened when you're talking about the 70s and 80s and stuff with a lot of American businesses. A lot of them reported earnings, but had no real earnings. Until inflation calmed down, because a lot of those gains are from things that actually couldn't have been cash that you take out of the business, because you immediately have to turn around if you want the same market share and buy things at higher prices. So that's the issue that you see. So you don't want something with a lot of, in the long run, in inflation situation, you don't want something that has a lot of inventory. Now, in the short run, if you have a lot of diamonds, if you have a lot of steel, if you have a lot of whatever, used cars on your in inventory, then you're going to make huge gains for that year. And so speculators will buy those things on that anticipation of this amazing earnings number. And it does generate cash. But then if you take that cash and put it back into more stuff, then you haven't really, had a gain. You're doing the same volume of business over time. And so those things keep taking that. If you have businesses that don't have receivables, don't have inventory, don't have any of that stuff, and have things that they've bought in the past or projects that they've spent on in the past, then that tends to be the better business, especially if they have very low labor component to their business. So licensing type businesses and things that don't. I mean, the best example is we talked about, what is it, FRP Holdings? Or is that right?
Yeah, the gravel pit.
So the two things they own. Now they are spending on stuff though now, but they aren't spending on the rock business, the quarries that were associated with Florida Rock. So they aren't spending on that. That's pure royalties. There's no CapEx that they do on them. So that obviously is a good business over time to have. And then the other thing is apartment buildings, basically some industrial stuff, warehouses. But those things, if you then turn around and buy more of them at high cap rates and things like that, or build them and stuff, are maybe not good investments. We don't know. But they certainly, the things that benefit from inflation relative to other stuff is things that you've invested in previously. So if you had a lot of apartment buildings and you had a lot of gravel pits, and you weren't going to buy more, then they would be good businesses, But that's the not going to buy more is the big part, because we've talked about that. Most oil companies that you look at or something might invest in more of that. Fossil fuel seems to be less lately. We'll see if that holds. But they've kind of underinvested what you would have expected by now. So you might do well in those things, but some of them might just be royalties or things like that. That's more the kind of stuff that would do really well.
It's like if you buy or you're looking at a company that has provable reserves in something like a quarry for the next 50 whatever years, it's like, well, they already paid for it a long time ago and they just get to benefit from the price of it going up.
Yeah.
Now, if they turn around and go and buy a new quarry, that's a different thing. But if they just kind of mint the already existing one, well, it's a great situation.
Yeah. And so that's what the issue often with like miners and things like that, people always say to buy, like we talk about gold miners or something. In many cases, it looks like gold miners should be a lot more attractive than owning gold. They don't always work out that way because of their capital allocation. But like if you looked at them and you thought that you knew what the capital allocation was going to be, then in many cases you think I should own a gold miner, not gold. If I'm going to own one of the two things, I should own the gold miner. They're actually cheaper. They should be generating a real profit from what they're doing. But in many cases, they then go out and buy stuff, and the way that they finance things and everything, they can manage to get returns that are as bad or worse than the metal over a decade or something, even though they were set up as looking a lot cheaper. Yeah.
So I'm going to ask you a tough question.
Okay.
If you were running the Fed, what would you do with the current situation?
I don't have an answer for that. I don't like to comment on because it's, as an investor, I just have to take what we're given, And so I don't like to try to see what I think the way things should be, but just take what we have as, that's the set of opportunities and stuff that we have.
That's the stoic way of looking at it, Jeffrey.
Because the Fed is not run to create nice investment opportunities for us,
Seems like they are, but yes, correct.
Yeah.
That's not within their mandate.
That's not what their job is. Yeah.
Independent, control inflation and the unemployment rate.
Yeah. So if you start to think about what would I do and stuff, then maybe that shades your views of the future of what will happen, Then you start to think that they're doing things wrong and they should do it my way, or you think that they will do it your way. You know what I mean? That's the kind of two things that happen to people when they start thinking that way.
But you have been thinking about it though, with your comment of, like a basket of these companies that could benefit from it.
Yes. I am surprised to some extent by relative pricings of some sorts of assets and things. It is difficult to explain. It is not just that obviously the market does not expect inflation to stay at the current levels, but the expectations from stock investors in many ways seems to be predicting an extremely different situation. Yeah, an extremely different situation than kind of the current numbers, or which is interesting, and I don't know what that's all about. To some extent, I think that buying things that are a little bit better protected against inflation things is still underpriced in the market. Not that they're great opportunities and all of that, but you don't seem to have, there's not sort of this speculative element that you have to pay up for in many cases to get better protection from inflation than in things that I think will not benefit at all from inflation, So what I mean is like, take something that would be really hurt by inflation theoretically, restaurants. If you look at the stocks and the pricing on them against things that own assets that would benefit from inflation more, that would be better protected against it, it just doesn't seem to reflect that kind of concern.
Yeah, I was looking at Meritage Hospitality Group, and in their last quarterly report, they're getting hit by labor, and it's compressing their margins. But it's like the stock didn't even move from it, but they're definitely feeling it in their financials. Yeah,
so restaurants are a really good example of one that can be hurt. Supermarkets are a good example of something that can be hurt. It depends. Restaurants much more so than the supermarkets, but they're ones that. But again, this is also a little bit of a difference between like looking at 1 year versus looking out like a longer term in the future, and maybe people are more focused on shorter term of whatever, but. Yeah, the restaurant prices compared to other things would surprise me. You would think that the things that own citrus groves and timberland and quarries and land in Maui and all that would be performing well compared to restaurants that use protein and employ minimum wage workers.
Yeah.
You would think that would be the worst thing that you could have, but the stocks don't seem to reflect that.
I wonder how often their rent for these places reprices as well.
Yeah.
Right? So if like there's roaring inflation and the value of these buildings are going up. I mean, I'm sure there's rent escalation clauses in there, but I'm just kind of curious. It's again, we've talked about it. I just feel like restaurants, they get squeezed from every angle, it seems like.
Yeah, and I don't know what will happen with things like rent, because that's the stuff that's complicated about these when people ask for predictions on this, because of interest rates. So obviously for a lot of this stuff, the offset that people could say is, well, the cap rate will be worse in the future then if you really expect plenty of inflation and stuff, so it adjusts to a significant extent. There's offsetting factors. And I think when we talk about a lot of macro things and people ask my predictions on it, the problem is there's stuff that happens now that you might predict then can set into motion things that work in the opposite way. It's not always self-reinforcing, as some of these trends are self-defeating. If like take interest rates and stuff like that. If you think the economy is running kind of hot and all of that, you might then think, oh, I should bet on that fact. But actually, if that is true, then likely there'll be policy things undertaken that would be more likely to slow down growth in the future. In a sense, that's how complicated it gets in that Keynesian beauty contest kind of way, because what you're doing is almost if you really wanted to speculate on those things, what you have to predict is, what do I think will be the case, or is the case, that the Fed and others like that will not recognize by a certain amount of points, such that it continues long enough, when we talk about reflexivity and all that stuff, that it continues long enough that I make a lot of money on this speculation. Because if it's something that is obvious and it happens, then a lot of other people will recognize it too, and there'll be a reaction to that, So I think it's the most I've ever been focused on macro things, I guess.
That's what I said. I feel like that's a lot of, it seems like it's a lot of investors now. Yeah.
Yeah. I guess, I think that's because of interest rates. Yeah. Just because of the disconnect of where interest rates are versus what could happen in the future. I don't like, this is true for all businesses, it's true for cyclical things and stuff. In general, businesses are worse off if the current environment they're in does not accurately reflect the normal environment they'll be operating in the future, because they make planning mistakes. And that's why you have cyclicality, because you react to current steel prices instead of thinking about steel prices years out from now. In insurance, you react by setting prices that are inappropriate now for future years, because you don't correctly estimate things about loss rates and things like that. You're working off bad information. A lot of times companies react a lot to the current situation, and that's fine in very stable industries. And so that makes usually being in consumer products and things like that a very easy business to manage, because you can manage your costs and things like that. Today is a pretty good idea of what they'll be like in the future. But in certain other businesses, it's not. And, like in banking, for instance, things that make sense now with your funding costs as they exist now, and with the rates that you can lend out and stuff now, looks like a good deal. But depending on what the situation will be in the future, that could turn out to be a bad deal, in the way that it does happen, like writing long tail insurance or something like that. And that's definitely an issue. And it affects all sorts of things. I mentioned once before, but it does affect insurance things too, because they obviously, it depends on what kind of insurance you're writing and stuff. If you're doing things that involve medical stuff and some things like that, you're fine. Those things are not inflating. But certain other stuff, you made an error in setting your rates, probably. Even just the level of inflation we have now, you probably are going to see not the level, but the amount of time, such a short period of time, even that affects an insurance company, in that they didn't set rates at the level that they should have. If they were expecting 3% inflation, they got 6 or 7 or 8 in the category that they were writing in.
Yeah, it's crazy to think. If you have $1 million portfolio, $68,000 of that, assuming this keeps up, is basically just being eaten away by inflation.
Yeah. And, and in some ways, depending on who you are and what your situation is, in some ways it's more expensive than that for some people, just because the affordability of housing and transport.
Energy.
Yeah, energy too.
And food, they take that out of a lot of these things, energy prices and food, which as a everyday American, I think is probably two of the most popular things that they spend money on, which doesn't make a lot of sense to me. Yeah, and actually it's interesting in the, when I was mentioning the restaurant stuff, it was interesting in the CPI, I don't know if people know this, food away from home is one that is an important number to look at, but food away from home actually includes food in institutional settings, which was down a lot. So actual inflation in restaurants is much higher. So if you look at just full service restaurant and limited service, which are the only things you can invest in really, unless you're investing like, I don't know which public things would be doing food in institutional settings, but basically there are all the restaurants and stuff, theirs is a bit higher than what you saw from food away from home, as a general category. So that's something to keep in mind. Those are more the ones I would look at normally. When, we've talked a little about inflation expectations and things like that. What I think does reflect that in normal times is things like food away from home, alcohol away from home, things like that tend to be pretty, they would not change those prices unless they expect it to continue.
in a way, so it's a small one-time thing is not something that they're going to shift their pricing on a lot. And so those are some more local things that have a better margin that way, as opposed to like when you're looking at meat prices and stuff, that's very market driven. Apparel is like a useless category to look at in terms of inflation. Electronics, those things are just very volatile. But when we talk about, but the difficult thing, of course, with COVID is, are there lots of other factors driving pricing at restaurants, movie theaters, things like that? Normally, those would be really good categories to look at. Very predictive of like what future inflation might be and what a normal level would be, because they would try to smooth out price increases. In those kind of categories, you don't want to increase your menu prices by 10% this year if you could do 3%, 3%, if you knew what it was going to be for the next few years. And so you see some extreme examples of that. Like we've mentioned Flanagan's on this podcast. Flanagan's carried out a menu price increase and drink price increase within like 6 months of doing it once before. So they obviously didn't plan for that the first time they did it. So that's a good example of that kind of thing. And there's just more things with companies that I've been looking at that obviously are changing certain policies. So I think I mentioned that auto suppliers changed some policies, auto parts suppliers. In their 10Ks, they mentioned that they now require repricing in many cases for based on commodities that go into the product. So normally it's a lot of labor. So if you're doing something even that's metal or whatever, the actual metal component is not a huge part of your cost. So they had generally not worried about doing that, but now they reset it quarterly in some cases for the automaker. So the automaker has to have it reset based on the price of the commodity. And so that's an obvious concern for them.
Was it Dollar General that raised
Dollar Tree?
Dollar Tree. Yeah. Dollar Tree's raising their mandate to, was it $1.25?
Yeah, they've thought about doing that a lot before, and this will be the time that they really do it. Yeah.
But you know what has not gone up? That Costco hot dog.
It will never go up.
It will never go up. The CEO, he will murder all of them. Or Senegal, I think that's his name, right? CEO, Senegal, something like that. Yeah.
Right. You have to keep that pricing on it. Yeah. Nathan's. Nathan's is a pure licensing business. They get a percentage of it from the...
See, but that's a great example of a business that doesn't have a lot of capital, right? Where
there's no capital,
the ability to raise prices. So just
so people know, they don't actually produce for themselves that way. They use... I wish that I could remember the name of the company that they probably use. But they use a meat producer that is one of the big ones. Like one of the... I don't know if they still have any licensing with Smithfield, but I'm trying to think of the other one that is, and I don't remember it. But they then produce for them what you see in grocery stores, and Nathan's just collects a royalty on that. Now, Nathan's in the past has lowered the royalty to help them out on when meat prices rose too fast versus like wages and things like that. And so that was obvious. So, it's not a perfect hedge that they have some guarantee that they're going to do that. But in general, it is obviously, if hot dogs cost a lot more in the future than they did in the past, that'd be beneficial to something like Nathan's because it tends to increase, the royalty. Anything that's a royalty. Mm-hmm. I mean, Buffett's talked about that, but honestly, anything that's a royalty benefits.
So like the whole toll booth. Mm-hmm. Music, it's like is that UMG, Universal Music Group?
Yep. Mm-hmm. Anything that is just a pure royalty, and that's what I was saying with the resource things. The pure royalties are more beneficial that way. And Nathan's is a rare example of that, but there are probably some other companies that are mostly licensing businesses.
What about the I can't remember the name, Music Trust? We've talked about it on the podcast.
Music Trust. So although you don't know, in many cases, will that change? See, hot dogs is a little bit easier to figure that they'll be increasing in price than music. I don't know. That is an interesting one. Online companies haven't dealt with price increases that have been meaningful in terms of inflation in their business. And so we'll see in some cases if they're able to pass along costs. Sometimes it might be hard for them. A lot of them built their business model on attracting a lot of volume growth with low prices. And so what do they do when it's time to increase those prices? But some of the others will benefit. To a certain extent, something like Google and stuff is just advertising. So if the ad market grows over time, then they're, like Buffett said, it's a gross profits royalty. So since it's an ad company, they'll do fine that way. Yeah. But labor, is the issue for a lot of these.
Yeah, wages have gone up. The
Yeah.
whole thing
Now,
with the
real
port.
wages are not up, but obviously nominal wages are up, and just more labor problems for some companies. Can you get enough labor? When you have a big disruption in employment of where people were working and everything, a lot of people are changing jobs, then you can have changes like this. That's we've talked about like in a theoretical sense about Japan, but that's a big issue in Japan, that there's so little change in the employment situation and everything because the front end of their labor, young people coming into the workforce is so small. It's even smaller than the things that you see with population growth decay, because people are living longer. So that kind of population growth doesn't even capture the new labor growth in terms of people coming out of school and stuff. Here you had lots of people changing jobs, lots of people changing their life in a lot of different ways. And that means that you're going to have a lot of change in all the agreements that you have. And that's what the labor things are. So those are the agreements that you have. And normally things don't change as much year to year. We talk about inertia and stuff like that. So the tendency to have, maybe it was possible for companies to pay higher wages in the past, but there wasn't much of a need to do that until you had a big change that way, just like you would with supply things, just like we talked about with, with agreements, with like agreements for parts and things like that. In those cases, they may have always wanted that, but it wasn't a pressing issue in the relationship until a year, like the one that they've had recently. If you had something that involves steel or something, it goes up by that much, then that forces that issue. And the same things with labor things. Maybe people weren't very happy with the wages that they were making in some cases, but there, was not high inflation numbers and things like that for them to point to. I think from a stock picking perspective, I don't like the idea of like buying inflation hedges and things like that. If you look at a lot of the mistakes that Buffett made, his outright purchases of things purely for inflation reasons, I think were not some of his best investments when he would buy things in, aluminum or oil or whatever, things that he was interested in that way. Although a lot of the investments in good businesses that had a better ability to deal with inflation. I mean, the See's Candies would not have been such a hugely successful investment for them if it hadn't been for inflation. That made it on a relative basis compared to other things much more attractive. Inflation does change the relative attractiveness of certain businesses a lot. So some stocks become relatively much better compounders versus others if there's a lot of inflation. We saw that when we did the 100 baggers, right? The companies that own timber and stuff were 100 baggers from the 30s through the 70s, but we're not 100 baggers from the 80s to 2010s or whatever. Just because it was really hard during a period of high inflation to keep up with the performance of just commodities and stuff like that. But in a later period, it's very easy, where there's really low inflation. So it does change those things. But I think we've always tried to be careful about that. Not because I prefer things that are protected from inflation, but just because I've said for a while, there's no premium for buying things that were, there was no sense that something that had bought meaningful assets in the past was a better business to own than something that has to pay most of its profits out for labor and for food costs and things like that. You just weren't seeing that, So like retail and restaurants and things were not trading at a discount to something that had a heavy asset component that it never had to invest in again, but we've talked a lot about that in the past, about the advantages of owning something that is a little bit more protected that way.
Sure.
Yeah. I just like, for instance, I don't think ad agencies have ever traded at some sort of premium over restaurants just because I think that they are a better business in inflation times. They traded as if the current period of, really low inflation and would continue indefinitely. And I haven't seen a big shift in any of the stuff we've talked about that way. Have you?
No. So, so what are your thoughts and like, what would your advice be? I mean, is that something that you would actually consider? I know you just said that Buffett, whenever he did anything specifically for inflation, it didn't really work out well. But I mean, is it really just sticking to high quality businesses, or would you actually be interested in buying a basket of something like Alico, MLP, Nathan's, or FRP? I mean, is that something that you would actually be interested in doing?
It's something that I've always factored in is how much they have to spend in the future instead of what they generate free cash flow. Big free cash flow generators are the kinds of things that you would want to own. And also, I've always worried about labor in the things that we've invested in. In recent years, there's just are not, strikes and things like that at all. And so people probably aren't that worried about unionization or something like that. But that's always been something that have been cautious of when investing in companies. It is an issue, and it's an issue. Like Village Supermarket or something. It's just more of a problem when you're in a business like that with the labor issues that you would have. There may be ways to offset it over time and whatever, but it's a completely unionized labor force. The industry, except for certain new players in that state, is completely unionized. That is an issue in terms of labor is such a big component of their costs. So that is something to think about. On the other hand, with inflation and stuff, I guess some people may like to see some, revenue growth and things like that. Certainly, I think supermarkets, I've thought for a while supermarkets offer a kind of attractive alternative versus restaurants. And I've been wrong about that. Society's completely gone in the direction, even with the pricing differential of food at restaurants and delivery and things like that, not driving them to buy more at supermarkets. It may be in the future that there's even more of that to the benefit of supermarkets versus restaurants. I think it's easier for supermarkets to reduce the labor component for them. And I think some of them have already worked on it pretty hard. And restaurants hadn't been, before COVID, working hard enough on that to compete with supermarkets. So, yeah. I mean, that's the kind of thing. If your real wages decline, it does encourage you to go buy from the supermarket than to go and eat out. That's certainly true. And I already thought, if you look at the last few years, the price situation in supermarkets before COVID, so the last few years before COVID, it was almost on the border of deflation and stuff, which is not something they'd seen since the 50s. And certainly not comparing food at a supermarket versus at restaurants, the gap was getting really big, but it was not causing a shift to supermarkets.
As in restaurant prices continue to go up, but prices at supermarkets continue to go down.
Yeah. And I would think that, supermarkets do need different labor and stuff, but for the most part, supermarkets are in a much better position to keep their workforce. They already have, and some of them have more stable workforce than restaurants. In some cases, you're comparing things like, Costco and stuff, which is a very stable workforce compared to the workforce of any restaurant. So even if they pay higher wages and things like that, they are in a better position relative to restaurants. Anything where you have the disruption of, like they did, closing down and then different levels and different hours and all the things that they did over time is very disruptive to the business. But even things that have been open throughout COVID and stuff are still having strong wage increases. Around here, In-N-Out is paying at levels that, to hire people, is paying at levels that 3-4 years ago would have been the best pay that anyone in that industry was getting, I
think I saw some for McDonald's, like $21.
Yeah.
And they're still having a hard time filling a lot of these positions. And I wonder if it's maybe the younger generation, there's been such a societal change where they don't want to work as much, or they're interested in doing other things. Here's something that's interesting, right? So it's like 10 years ago, if you were a reporter and you worked online, you could make a lot of, or worked not online, you worked for the company, you could make, whatever. A lot of the reporters, sort of the trend has been, I could just, start a Substack, start a Twitter, produce my own content, own my own content, put out, do whatever I want, and make the same amount of money, if not more, over time.
Yeah. And the best ones will.
Yeah. So how much of that is transitory versus like a societal shift? And it's like, how do you gauge that? Maybe it's hard to do in the short term, though.
I don't think there's much of a societal... I don't pick up on much of a permanent societal shift. I think the people... I've heard a lot of people saying that there is. There was a lot of stimulus, a lot of credit availability, And just the gap between, for a short period of time, but the gap between working and the life that would cause you to have at an entry-level job and the life that you were living was not very different during COVID. So yeah, I mean, I've talked about, like, I visit some places that are very, very, very poor counties and stuff. Yes, in those places, there's no incentive to work because the amount that you can make at all but the best jobs and what there's available to spend your money on is not very attractive versus the level of subsistence that you would get from government support. But that's extremely rare in the United States. That's, present in some very poor, very rural counties and stuff. And then I think in those places you do have, you have permanent, a lot of people that are not going to seek full-time employment in those places. They might seek sort of semi-entrepreneurial things like you're talking about doing and stuff like that. But yeah, the advantages of a full-time job there are not very big. But around here or something, no, I don't think that's true. I don't see that. The advantages are very big for being employed versus not. I just think that a big part of it is just the shift that we see with the disruption. I compare it to like 1946 in the U.S. and stuff, where you had demobilization. So you had so many people that went into the military for several years, and then you had them come out, and then what that did to the labor force and all that. And there were some effects from that. You saw some pretty extreme effects. So it was brief, though. It was a blip. You saw a lot of strikes. It might have set a record around that time in terms of strikes that you saw. And you saw momentary effects on like inflation and things like that. The difference, though, is, government policy at the time was, well, it quickly became not running deficits, And now the policy is interesting for the years ahead, right? On an absolute basis, both monetary policy and fiscal policy are loose. But on a relative basis, in terms of sequentially, they'll be very tight. The level of reduction in deficit, level of tightening, in terms of amount of time period in which it happens, will be extremely tight. But on an absolute basis, again, like, it will, over the long-term norm, be loose. It's just that if you're expecting the last year or two to have been normal, it will be a lot different from that. The speed of it will be extreme. So we have lots of different periods, and it's hard to predict what things happen in each case because of that. Obviously, people expect this to be more temporary than it's proven to be, I guess. I don't know how it could be more temporary than it. We're not very far along. It'd be hard to be more. It'd be hard to be more temporary than this. People wouldn't change prices on a lot of these things we're talking about if they really thought it was going to be that short term. And I don't know. I wrote a thing to managed account people, like at the beginning of the year or whatever. I guess was the beginning of the year or whatever it was, saying that this would be the best year for used car things. And it's happened like we expected. But like, you knew that would happen because inventories were nothing. So in some ways, I'm surprised by the reaction over this period of time. Because if inventory levels of things are that low, then that's bound to happen in things like that. It's not like the stock market. The stock market clears every day. So you have these big moves. If you have an imbalance in something like cars or homes, there's a lot of momentum for a long period of time because, it doesn't work the same way. It takes a very long time to adjust. You've seen that in China, where I saw there's predictions from people of slight growth in the price of homes in China, 1%, 2%, 3%, but there's huge volume declines. And that's normally what you see with homes, is that the big volume declines happen before any price declines at all happen, because the market just like seizes up. Which is very different from a stock market. In a stock market, when people realize that prices are going to drop, they do drop. With homes, you just say, I'm not selling my house then. Yeah. And you hold on longer. Yeah. You don't sell it the way that you do a stock. And so I think a lot of it could also be a disconnect with us where the economic data like this does not move as fast as the stock market moves. The stock market adjusts in a big way very quickly compared to these things that have a lot of momentum built into them. And so when you get into a really tight situation with lack of inventory, supply of different things, and it takes a long time. how long ago was it that we knew all these different businesses saying they were having trouble getting labor?
Sure.
So then it's not a surprise that they have to raise the what they're offering to bring people in. That's only, how else do you incentivize them?
Yeah, sure. Yeah, I don't know. That's a good question. Because you're right. I mean, that's been 2021. I mean, that's been a problem since what? Like the bottom of the pandemic. Really.
Yeah. So I just mean it takes time for people to, it's different from the stock market.
Is it almost like because the data finally catches up to it?
No, you know what happens is because like what I mean is the, like we see the data later and everything, but when you read these transcripts and people say these things, then you know the direction that has to go eventually. Because in a stock, if you're saying, I really want this stock, but they won't come down to my bid, right? Well, people don't just sit there for 3 months waiting. But an employer does.
I feel like we do.
They sit there for 3 months saying, I can't get any labor. And then finally they say, okay, I'll raise it. I'll put out the sign. Raise it. Yeah. Because they do wait much longer than you do in a stock market. Because, I mean, I could just anecdotally about so many different industries, how long they said, we have no inventory, we can't get our orders filled, whatever, for these things. And they knew, like, that prices were going to go up. Or some people will tell you, you do hear this a lot when you talk to people who are not in, like, stock things and stuff, but just in business, that, yes, they can't get their order filled. Yes, they order twice as much and then get half of what they wanted. Yes, everything's back order or whatever. But that doesn't mean prices will go up. Well, it does mean prices will go up.
Yeah.
I mean, that's the only, like, that is what will solve it. Otherwise, unless you have an agreement by everybody not to do that, we'll all make do with empty shelves. That's exactly what causes prices to eventually go up. Like, those are the things, that's why prices move up
too much
down.
Money chasing too few goods.
Yeah, it's supply and demand that way, yeah. And it's just that with stocks and bonds and things like that, we are used to markets that the volume doesn't disappear. The price moves to accommodate the volume, and so the price moves, we're used to very big price moves, right? But that is not what happens in these sorts of markets. So in, like in a labor market or something, you have a change in quantity because you didn't move the price, because people just are not going to say, okay, 10% across the board price increase, and that will get us all the labor that we need, or whatever, whatever it is. But in stocks, that's what it'll move immediately to make sure that happens. The market keeps moving that way. So I just think it's a big difference between them that, we have to deal with, that you're like getting these constant flow of things and people talking about it as if it's been a really long time. It really hasn't been that long. When you read about these things in like I was saying with 1946 and stuff, you read about these things there when they mention 2 years of something, it seems like, oh, so that was a short period of time.
Yeah.
But here, talking about
when
it
you're
every
living
month.
in real life. Yeah. Yeah. We always talk about that. I feel like with investing, how it's just like we look at it through a different lens because we're looking at the past and the present, and 2 years seems like 2 seconds, but that's not the case in real life. On a going forward basis.
Yeah, and there's also even people looking forward, so they kind of the market almost gets over things that are even happening right now, like with the movie theater things.
Yeah, I was looking at that recently.
Yeah, so movie theaters, they're basically for the last quarter, if you adjust for all the things they adjust for their EBITDA and whatever, maybe they're at about zero.
Yeah,
they didn't actually generate cash.
And box office hasn't been really improving domestically.
No, so box office now box office will make a prediction here.
So you're here to make this prediction. All right. So
box office compared to this past quarter we just had and earlier in this year is going to be really strong in the next quarter.
Okay, what leads?
And I'm predicting that. No, the only prediction is supply. Yeah, is that's what determines it. Now, if we look, you got Box Office Mojo, or like I said, the numbers. The numbers is probably more. Better now for it than Box Office Mojo. But, I predicted James Bond, right?
Yeah.
And I was not correct on that. I said it would do 150 million US and 500 million in the rest of the world. And it did significantly more in the rest of the world than I thought it would. But it probably ended up at 750 million or something, pretty close in the US. I just think the lineup. Yeah, okay, so... Oh, it doesn't tell me, but James Bond's No Time to Die thing there. So I think the lineup is strong for the movies. The problem that you've had with movies is very, very weak lineup. Like, for instance, the James Bond movie.
Yeah.
Honestly, it did about that's about what a normal Daniel Craig James Bond movie does worldwide. Yeah, it's about consistent with it. Skyfall did maybe twice that or something in the U.S. And a bit bigger in the rest of the world. But an average James Bond movie did about that, and that's normal for that. I think The Eternals basically did what it would do outside of COVID. Not that it was really strong numbers for a Marvel movie, but I didn't think it was ever going to do really strong numbers. So the like really big ones, that have been released haven't been that far off. But you're right that if you look at box office versus restaurants, for instance, if we look at like on a nominal basis, restaurants in some cases are like 90%, depending on how short a window you make it of this month versus versus before COVID month, are like 90% or something of what they were at. Whereas box office, we're talking about down over a third or something. Yeah, still. If you try to compare apples to apples, I'd say you're at, in a sense, box office is at maybe 60% of capacity. Restaurants are at 90%. Now, both those are... Restaurants more so are affected by the inflation thing. Like on a real basis, I don't think restaurants are really that close to being back.
Yeah, I was looking at Cinemark recently.
Yeah.
Just looking at the price and everything. Marcus, everything.
Yeah, so I had said before with Cinemark that I was kind of surprised by the strength of those stocks actually during the like summer period where I didn't think that the box office results were that strong. Now I think that the issue is like what we talked about before, where I'm more worried about like changes in the way that these movies are distributed and all that.
Yeah.
I do think that basically you're almost seeing the big movies do about the same as they would have done outside of COVID, but that also can be less competition, that they're not facing as much competition. But like even things like, some of these things have probably been cannibalized a bit by video, going on to streaming and stuff like that faster. Although the companies make plenty of money off of that, the distributors and stuff, because they do a premium, like, Disney and stuff doesn't. Warner Bros. Is the only one really. There have been others actually, like technically Peacock, but it's not a big streaming service. Release things right away on that.
I am a subscriber to Peacock.
Do they have The Office?
Only for The Office. That's it. That's literally. I didn't watch The Office for months because they took it off Netflix, and then finally I was like, I'm gonna pay $10 or whatever it is to watch my favorite show.
It is interesting. So like a year or so, they can collect more money from you than it would be to buy the whole thing physically.
Yeah, I know. It's like, why don't I just buy it physically? But then,
then you have to have it physically. Yeah.
I don't have a CD player or DVD player. But
right.
To your point, though, if you factor in how, I'll probably watch The Office forever. Yeah, versus actually owning it myself.
It's a convenience thing. Yeah. No, I think that for some audience, like as for instance, I do there are movies I think will be very affected, and we've seen evidence of it. Any movie that was targeted at older audiences, by which I mean that they don't have a significant like 13 to 30 audience thing. So like House of Gucci, right? That I think will probably not do as well as it could have, right? Just because you'll have more people who would watch that, who say, I can watch that when it comes out, because they know it's not that long before I'm able to see it in some streaming platform if they want to see it. So definitely older audiences that way, which has already been a harder thing for movies to reach anyway. But among younger audiences for the things that like, even James Bond skews pretty old, pretty old for an action, franchise type thing, and it did fine, so I think those big movies will do fine that way. But some of the just like straight dramas and stuff, I think have a really hard time. It's almost more like the way it happened with plays on Broadway, where we're just, like musicals and stuff just became the market, taking out all sorts of different plays that 50 years ago would have done some money. Now I think the same sort of thing. If it's not a CGI event type movie that's going to bring in younger audiences and stuff, I don't know that it'll do as well now, and I don't know that it'll get as big a window.
It's interesting how the shift between like movies versus TV. I feel like 20 years ago, if you were an actor and you were doing TV, you were like dead on arrival, right? It was
Right.
always you had to do movies. But nowadays, it's the TV shows. If you get a hit, it's like a huge big deal.
Yeah, and then there's even a thing of like where the line is on those things of what's a movie, what's what we really think of as a movie and versus TV. When you have something go on a streaming platform and have 6 episodes of something, that's in many ways similar in production to doing a movie.
Because I've seen some shows before. I'm like, that would have been a good movie, and I just spent 10 weeks watching.
Well, it's a big thing for Disney because Disney has to decide what, and they may decide wrong. Should the Eternals have been a movie, should Hawkeye have been a movie? Should the Eternals have been a TV show? Should things like that? They have to make those decisions, and they'll do fine that way. But I think for the gap has closed. I think that's what I was talking about. There was a certain prestige element to seeing for something coming out in theaters versus DVD only, a TV show, whatever. It had an event element to it that helped you out. And I think that is a problem. Now, the movies that I just said that like kind of I think did okay are James Bond and Marvel things, which are still considered events, for the people who they're the audience for them, that's built in. It only comes out every so often, even a Spider-Man thing, it is a couple years between an actual Spider-Man movie, so it will be an event for people who are fans of that. Whereas like just a typical, it's a Mark Wahlberg movie. That's the kind of thing that would be hurt more if it's not a part of a franchise. If it's not Transformers or something like that, then I think that it will not do the same in post-COVID times.
Does Transformers still make movies?
They did. They attempted to like spin off at a lower production cost and stuff like that. Yeah, eventually I'm sure they'll do things again.
Bring a new generation of eyes.
Yeah. So I think that's one of the changes that's happened with COVID. But I mean, the big one for those is the debt. I've looked at them. I mean, I haven't looked at AMC. I mean, I've looked at AMC, but not as a stock.
I was going to say, what do you think about the streaming window and how that affects AMC? That's a joke.
But I have looked at Cinemark, Marcus, things like that. Reading is another company.
We did a lot of work on Marcus in 2020, I would say, visiting different places and stuff.
Yeah. I don't, they're not super cheap when you factor in the debt and stuff like that. I've said before, I think they're kind of, they're down, some of them from where they were, but when you factor in on an enterprise value basis, I do feel like you're basically pricing it that it's back to where it was. Marcus, of course, has the problem that they have hotels that are very driven by business travel. And that is something that I do wonder about. I'm not sure that business travel and business
events,
in general. Yeah, we've talked a little bit about that. I'm not sure about commercial office space will be exactly the same that it was before. I'm not sure that hotels that cater to events and conventions and things like that will be quite the same. Even if I think that, in the long, and I think I said that with booking when we talked about booking, I don't feel that in the long run, this is really a permanent difference in terms of people's personal travel, leisure travel. I do think that will basically be on the same trend that it would have been with or without COVID in the long run. It'll take a little while to get back there. But I do think you were talking about like things that actually change, like whether people's appetite for work changed, I don't know, but their appetite for working in an office has changed.
Oh, sure. Yeah, certainly.
Yeah. And maybe that affects things. I don't know. Maybe that does make it harder on service things that we're talking about, that are like, whether it's working in an Amazon warehouse or working in a restaurant setting or something like that. Maybe it is particularly hard on those labor things because that kind of job, people may not assume that all jobs are like that. Right. That job is not very flexible, those jobs. They're very not flexible versus an office job. Office jobs have gotten even more flexible now. So maybe it is a little bit tougher, I guess. Because it's interesting if you look, like some of those, people may not realize it, but like some of the things we're talking about with restaurants and what they're hiring at and stuff, fast food things, is actually pretty much in line with some entry-level things for office stuff. They're going to be about the same. And so maybe people feel like, well, the office thing's a lot more flexible.
Yeah.
Yeah.
Oh, it's kind of like you've seen that even with the education system. You could go to college and then become a teacher like a elementary, middle, or high school teacher, not private, public.
Right.
Or you could go work in a Amazon warehouse and make probably about the same amount of money.
Right. The difficulty, I think, for that kind of thing, for Amazon and stuff, is what you were saying about like if things have changed. Maybe some things have changed in attitude about certain kinds of work that's more common in industrial manufacturing and things and food service stuff. Like I was saying with a supermarket and stuff, that kind of job may be less attractive to people than a job that is a white collar office type job if it's so much more flexible.
Yeah.
Because not that long ago, many entry-level office jobs were weren't actually not all that flexible compared to the kinds of jobs we're talking about. They both involved punching a clock in pretty much the same way.
Yeah.
But that has certainly changed a lot, where plenty of people will spend at least part of their time not working in an office, and maybe that's attractive to them.
Got it. Cool. How long has this podcast been? Let's see. Is this a record? Hour, 8 minutes. Well, I want to thank everybody so much for tuning in with the both of us on the Focus Compounding podcast. I love doing these news episodes where it's just more timely, more not news, but just more timely stuff and how we're thinking about it, as opposed to timeless content. So we'll definitely do more of these in the future. People
so if you're
actually
listening to this in a few years.
Yeah, I know,
it's
right?
not worth anything.
Yeah, well, that's true, but this is the best for views, best for clicks. That's what everyone's thinking about. But I do think people enjoy listening to how you're framing
content, as opposed to evergreen content.
Yes,
this
timely,
is deciduous content.
Yes,
yeah,
timely. So I want to thank everybody so much for tuning in with the both of us. Be sure to hit that subscribe button wherever you're listening to us. Go to quickfs.net and sign up there and tell them that you came from Focused Compounding. And of course, follow me on Twitter. That's the best place to get everything that I put out there on the internet, Focused Compounding related. We're about to do a Q&A right now. And if you want to be on the lookout for that in the future, easiest way to do that is to follow me on Twitter. Thank you so much for everybody for all the support. We'll see you in the next podcast. Take care.